Okay, let's dive into the material you send over, the articles, research, your notes. It's all focused on dividend investing. And I really get the appeal here, right?
Hmm.
For so many people, dividend stocks feel kind of like comfort food in a portfolio.
Yeah, there's a stability there, or perceived stability.
Exactly, that predictable income stream.
Yeah.
It's just a hugely popular way to build wealth.
It really has a strong gravitational pull. You know, that feeling of actual cash hitting your account, separate from the stock price just bouncing around. It's attractive.
Absolutely.
Yeah.
But looking through your sources, one of the first things that kind of jumps out is that this very comfort,
Mhm.
this feeling of predictability, it can actually lead to complacency.
Right.
And according to this research, that's where the risks often hide.
That's really the core message here from the material. The usual story around dividends focuses on the good stuff, the income, the compounding, but maybe doesn't give enough airtime to the potential downsides, the complexities that aren't always obvious.
So that's our mission in this deep dive then. Based specifically on these sources you shared, we're going to unpack the risks of dividend investing, the side that gets less attention.
Yeah.
This isn't about saying dividends are bad, not at all. It's about understanding the potential landmines, the pitfalls that your material flagged.
It's about getting the full picture, drawing straight from the insights in your sources.
All right, let's jump in. The sources definitely acknowledge the allure, that high yield, the promise of passive income. It is seductive.
Very.
But right away, they bring up the first major risk. They call it the yield trap.
Right, yeah, this is a classic one. What looks like a really generous, attractive high yield on a stock, it isn't always a sign of strength. Often, it's actually a flashing red light, a warning sign.
Okay, so why? Why is the yield high in that case, according to the sources?
Typically, it's high because the stock price is tanked. It's fallen significantly. And stock prices usually fall because the market sees trouble, Problems with the company or its future isn't looking too bright.
Right. So the yield percentage looks big. Just because the denominator, the price, got smaller. It's a symptom of distress, not success.
Exactly.
The sources use AT&T as a pretty stark example of this, Tom.
They do. AT&T historically had a very high yield, sometimes north of 6%. But the source material pointed to these underlying issues like massive debt and what they described as a sort of dated business model for today.
Okay.
And despite that high yield, those fundamental problems eventually led to a big dividend cut in 2022. Plus, the stock underperformed for ages.
Yeah, that example really drives home the lesson from your sources. You absolutely cannot just look at the headline yield number and think, great, I'm safe. You have to look under the hood.
That's the critical takeaway for avoiding that yield trap. The research really hammers on digging into things like the payout ratio, like what percent of their earnings or free cash flow are they actually using to pay this dividend? Is it sustainable? Look at their free cash flow generation, scrutinize the balance sheet, especially the debt levels, before you get lured in by a big yield number.
Okay, so avoiding the yield trap is step one. But what if you pick a company that seems stable? Your sources talk about the nightmare scenario for any income investor. A sudden dividend cut.
Yeah, this is described as potentially catastrophic, especially if you're relying on that income, maybe in retirement. And the most unnerving point from the sources is that these cuts often happen with very little or sometimes zero explicit warning.
Zero warning, just bang, income gone or slashed. The material does list some specific red flags, though, things to watch out for that might signal a cut is coming. What were those key signs?
Several things stood out. A payout ratio consistently over 100%, that's a huge red flag. I mean, a company paying out more than it earns or generates in cash, that just can't last.
No.
Negative or declining free cash flow is another big one. Falling revenue, shrinking profit margins. Those show the business itself is weakening. High debt loads, too. That can make it tough to keep paying dividends, especially if interest rates go up.
And there was that interesting behavioral red flag the sources called out, something about management reaffirming the dividend, maybe a bit too loudly.
Yes, that detail is fascinating. The research suggests that when management goes out of their way, maybe unexpectedly, to loudly declare how committed they are to the dividend, it can sometimes be a defensive move. It might actually signal that the dividend is under pressure internally, rather than being rock solid. It's almost like if they have to shout about how stable it is, maybe it isn't.
That's a great piece of sort of counterintuitive wisdom from the material. Okay, moving on. The next risk isn't sudden like a cut, but it's more like a silent thief, eroding value over time. Inflation.
Precisely. Inflation just slowly but surely eats away at the purchasing power of your income. If your dividend payment stays the same every year, you can buy less and less with it.
Right.
So the sources strongly emphasize that for dividends to really preserve wealth long term, they absolutely need to grow.
And this leads to the strategy the sources champion to counter this: dividend growth investing.
Exactly. The focus shifts. It's not just about chasing the highest yield right now. It's about finding companies that have a proven history and the financial strength to consistently increase their dividend payout. Ideally, at a rate that beats inflation over time. Companies like, PepsiCo, Johnson & Johnson, Microsoft, they often come up in this context because they have strong track records of raising dividends.
And your sources included a pretty powerful illustration of why that growth really matters more than just a high static yield.
They did. They show how a stock with what seems like a lower starting yield, say 2%, but that grows its dividends steadily at, say, 10% a year, can actually end up generating more total income and give you a higher effective yield on your initial investment within just a few years. Compared to a stock that starts with a high but stagnant 6% yield, it just highlights that the direction of the dividend is often way more important than the starting point.
Okay, let's talk about something nobody can avoid: taxes. Your sources make it really clear it's not just that dividends are taxed, but the type of dividend really matters for what you actually keep.
Oh, absolutely crucial point. The difference between qualified and non-qualified dividends is huge. Qualified dividends get taxed at the lower long-term capital gains rates,
Which are much lower than regular income tax rates for most people.
significantly lower, yeah. But non-qualified dividends, they get hit with your ordinary income tax rate.
Which would be, what, up to 37%? Much higher.
Potentially, yeah. And here's the specific trap the sources point out. Distributions from a lot of popular high-yield things, income investors like certain REITs, real estate investment trusts, BDCs, business development companies, and MLPs, master limited partnerships often, those distributions are considered non-qualified income if you hold them in a regular taxable brokerage account.
So you might get this nice big distribution, but then a huge chunk just vanishes because of higher taxes. That's what the sources call tax drag. The suggested fix involves being smart about using tax-advantaged accounts, right?
Precisely. The material points out these investments throwing off non-qualified income are often way more tax-efficient inside accounts like IRAs or 401ks where taxes are deferred or maybe even eliminated.
Okay.
For your taxable accounts, focusing on qualified dividend payers, which includes many solid dividend growth stocks, can be much better from a tax perspective. Tax planning isn't just an extra, it seriously impacts your net returns.
Another risk that seems almost built in if you're just chasing yield is sector concentration. If you're only looking for high yields, you tend to end up fishing in the same ponds.
That's the natural tendency the sources describe, yeah. Investors looking for income often gravitate towards sectors known for higher payouts, utilities, real estate, consumer staples, telecoms.
Right.
But the problem is that doesn't really give you true diversification. It actually leads to being exposed to specific sector risks.
Exposed to what, for instance?
Well, the sources use interest rates as a key example. What happens to utilities and REITs, classic dividend investor favorites, when interest rates spike?
They tend to get hit hard.
Yeah, they do. Partly because their business models often rely on debt, so borrowing costs go up, and partly because investors looking for income suddenly have safer options, like bonds offering competitive yields. They might sell the dividend stocks.
So owning, 50 different utility stocks isn't really diversification in the way the sources mean it.
Correct. Diversification, according to this material, is about spreading risk across different types of businesses, different economic sensitivities, different geographies, maybe even different asset classes altogether.
Okay.
Being heavily weighted in just a few yield-heavy sectors means your portfolio's fate can be tied too closely to factors affecting just those areas. It leaves you vulnerable.
Let's talk about reinvestment risk, especially with DRIP's dividend reinvestment plans. Automatically reinvesting sounds great for compounding, but there's a hidden danger there too.
DRPs can be fantastic tools for compounding, no doubt, but the risk is precisely that they're automatic. If you're automatically plowing dividends back into a company whose fundamentals have started to slide, or maybe the stock has gotten way too expensive, you're essentially just doubling down on a bad or maybe just a suboptimal investment decision without even actively choosing to do so.
So the automation takes away that necessary moment of decision.
Exactly. The sources suggest that if a company's story changes for the worse business prospects decline, valuation gets stretched. You shouldn't just blindly let the DRIP continue. Maybe take the dividend in cash, pause, assess the situation, then make a conscious choice about where that money is best put to work. Is it back into that stock if the price is better? Or is it into a completely different opportunity? Allocation should be deliberate, not on autopilot, especially if things change.
That's a really good point about active thinking. Now, if you're looking outside the U.S. for dividends, there's another layer of risk. Currency risk.
Yes, this definitely applies when you invest internationally. You're not just buying a piece of a foreign company, you're also implicitly taking on exposure to the exchange rate between that foreign currency and, your home currency, the dollar.
And that fluctuation can seriously impact your actual return. The sources gave a clear example, I remember.
They did. They described buying, say, a UK stock that pays a decent dividend.
Sure.
But if the British pound then weakens significantly against the US dollar, let's say by 10%, before those dividends get converted back to dollars for you.
Ouch.
That currency loss can really eat into or even completely wipe out your effective dividend income and your total return in dollar terms.
Wow, yeah. That's a powerful effect that can happen almost silently if you're not watching it. What did the sources suggest to kind of lessen that risk?
Well, they mentioned diversifying across different countries and currencies so you're not overly reliant on any single one. Some specialized ETFs also offer currency hedging, but that adds another layer of complexity and maybe cost.
We touched on interest rates with sector concentration, but the sources actually list interest rate sensitivity as its own specific risk for dividend stocks.
They do, yeah. Because many high-yield dividend stocks, especially those ones we mentioned like utilities and REITs, tend to behave a bit like bonds. Their value is often heavily influenced by what interest rates are doing.
And how does that play out when rates rise?
Well, when safer investments like government bonds or high-quality corporate bonds start offering higher yields, income investors who are in dividend stocks, mainly for the yield, might shift their money over to those safer options.
Right, less demand for the stocks.
Less demand, exactly. Plus, companies with a lot of debt or those in really capital-intensive sectors like utilities face higher borrowing costs when rates rise. That can squeeze their profits and maybe even their ability to keep paying the dividend. So the market often just reprices these stocks lower.
It really highlights that even these seemingly stable dividend payers aren't completely insulated from the wider economy. Okay, next up, let's get into the psychology side. Behavioral biases. The sources focus on this tendency to chase yield over actual quality.
This is a really fundamental human thing, the research points out. We seem hardwired to be attracted to the biggest number, the highest percentage, the shiny object, right?
Yeah.
But the sources argue that this urge for a high yield often makes investors overlook or maybe downplay really critical information about the quality and the sustainability of the business underneath that.
Yeah, it poses a pretty stark choice to illustrate this bias, don't they?
Yeah, they basically ask you to consider, would you rather own a maybe boring but fundamentally solid company yielding, say, 2.5%, that reliably grows its earnings and dividends year after year,
Okay.
versus a financially questionable, maybe risky company yielding a flashy 11%, but it's got a history of problems and its future is really uncertain. Your gut reaction, your emotional brain might scream 11% free money, but the rational approach, according to the sources, is choosing consistency and quality over chasing potential chaos.
So successful dividend investing, they argue, really requires discipline, patience, and just a healthy amount of skepticism when something looks maybe too good to be true.
Absolutely. The quality of the business, the sustainability, the growth prospects of that dividend, those are far more important for the long haul than just the current yield number flashing on the screen.
How about liquidity risk? This sounds like it applies more to smaller or maybe niche companies.
That's often where you find it, yeah. Some high-yielding investments might be in smaller companies, maybe microcaps, or specific structures like some MLPs.
Yeah.
The risk here is illiquidity.
Meaning
There just aren't that many buyers or sellers for the stock on a typical day. Trading volume is low.
And the problem with that low liquidity is?
If you need to sell a decent number of shares, maybe quickly because something changed, you might struggle to find enough buyers at the current price. This can force you to accept a lower price than you wanted, basically pushing the price down as you sell. The source emphasizes that liquidity is one of those things you don't think about until you desperately need it.
Yeah.
And it can be a hidden cost or risk. Always good to know how easily you can actually get out of an investment if you have to.
Let's talk about management shenanigans. This sounds like companies doing, well, tricky things just to keep those dividend checks flowing.
It is. The sources highlight warning signs that a company might be prioritizing the dividend payment, maybe to keep investors happy, even if the core business isn't really generating enough cash to support it sustainably.
Like what kind of things?
Things like borrowing money specifically to pay dividends, or selling off valuable assets just to generate cash for payouts, or even using aggressive accounting methods to make reported earnings look better than they really are just to cover the dividend.
Okay.
Yeah.
What are the specific red flags they list for that kind of behavior?
Key things to watch for are dividend payouts that consistently exceed reported earnings, or even better, free cash flow over time. Also, frequent issuance of new stock equity dilution that seems aimed at funding operations or payouts, and rising debt levels when the company's actual revenue isn't growing. These actions can signal that the dividend isn't coming from healthy operations, but more from financial maneuvering, which makes it likely unsustainable.
If a company is basically borrowing or selling the furniture to pay the rent, the dividend, then yeah, a cut is probably on the horizon.
The sources definitely suggest these are strong signals of potential future dividend trouble.
This next one is more of a theoretical idea the sources discuss, the dividend irrelevance fallacy. It's this kind of academic concept that dividends don't really matter because you could just sell shares instead.
Right. The pure finance theory argument is that getting a $1 dividend is mathematically the same as the company keeping that $1, your stock value going up by $1, and then you just selling $1 worth of stock to create your own income.
From a balance sheet perspective, maybe.
Yeah, the total value might seem similar on paper.
But your sources push back on that, saying humans aren't robots investing based on formulas. We invest emotionally.
Exactly. They argue that for many individual investors, especially those focused on income, getting those regular, tangible dividend checks provides real psychological comfort. It can help them feel like they're succeeding even when the market's down. It's concrete cash flow, which might help them stay invested and resist panic selling when things get volatile.
So while it might be mathematically debatable, the actual behavioral impact of getting dividends makes them pretty relevant for a lot of people. But the sources also add a little counterpoint to that too, right?
They do. While they acknowledge that behavioral benefit, they also warn against falling into the trap of thinking dividends are the only thing that matters.
Oh, okay.
The ultimate goal, the real measure of success over the long term, is total return. That includes both the dividends you get and the change in the stock's price, the capital appreciation or depreciation. Focusing only on the dividend while your stock price is steadily falling is definitely a mistake.
Good reminder. It's the whole picture that counts.
Yeah.
Okay, risk number 13, macro shocks. Dividend stocks aren't immune to big economic events.
Not at all. Recessions, pandemics, financial crises, these big economic downturns hit corporate earnings hard, right across the board.
Yeah.
And when earnings fall, a company's ability and maybe even its willingness to pay dividends is directly threatened.
The sources had a really telling statistic from the COVID crash that shows this vulnerability.
Yeah, they pointed out that during the market chaos in 2020, over 200 companies just in the S&P 500 index either cut or completely suspended their dividend payments.
Wow, 200.
And these weren't just tiny companies. It included huge well-known names like Bank of America, Disney, Boeing.
So if your whole investment strategy, and especially your income stream, depends only on corporate payouts, you are absolutely exposed. You're vulnerable to major disruptions when the economy hits a rough patch.
It's a stark reminder. Even companies with really long, great dividend track records can face immense pressure in unprecedented times.
And finally, the last major risk area your sources highlighted. Overconcentration in just dividend stocks versus other kinds of assets.
This is sort of the concluding point the material makes, that being a dividend investor shouldn't mean your entire portfolio is just dividend-paying stocks and nothing else.
What other types of assets do the sources suggest are important for a well-rounded portfolio, even for someone focused on income?
Well, they mention things like bonds, which can offer stability and might behave differently when interest rates change. Growth stocks for capital appreciation potential that could outpace dividend growth. Real estate, often seen as an inflation hedge. Maybe even commodities or gold for diversification and hedging against certain risks.
So the key takeaway there is that a portfolio made up only of dividend stocks, no matter how well you pick them, could still be kind of brittle. It might lack diversification against risks that hit stocks broadly or specific sectors particularly hard.
Exactly. The ultimate goal is building long-term wealth and meeting your financial objectives, right? Not just collecting dividend income in a vacuum. A multi-asset approach, even for an income-focused investor, is really crucial for building a portfolio that can weather different storms.
Oh, okay. That's 14 distinct risks we've unpacked from your sources.
Yeah.
It really lays bare the idea that dividend investing, while it offers certain comforts and benefits, absolutely introduces its own unique set of challenges and potential pitfalls. It's definitely not just a simple set it and forget it kind of thing.
It really changes the nature of the risks you're taking on compared to, say, just investing purely for growth. But the idea that it's inherently safe without understanding all these nuances, that's a significant misconception the sources really push back against.
So drawing it all together, the core takeaway from your material seems to be this. Dividend investing isn't risk-free. It just shifts the kind of risks you need to manage.
And the real value in knowing about these potential landmines, the yield trap, the signs of a cut, the drag from inflation and taxes, concentration issues, macro vulnerability, all of it, is that it empowers you, the listener, to build a more robust, more resilient portfolio, even one that's focused on generating income.
Right. The sources suggest taking proactive steps, really prioritizing companies with dividend growth over just the highest current yield number, making sure your portfolio is truly diversified across sectors and even asset classes, being smart about where you hold different types of dividend investments for tax reasons, and constantly doing your homework on those fundamental health checks, payout ratios, free cash flow.
That due diligence is it's not optional. It's fundamental to successful long-term investing, whether it's dividends or anything else.
And that leads perfectly to the final thought the sources leave us with, something for you to really mull over after this deep dive. Dividends, while they're a fantastic feature, a great benefit, they are ultimately just that, a feature. They are not a guarantee. Don't let the comfort or the perceived predictability of those payments lull you into complacency. Because as the research you shared makes crystal clear, the market has plenty of ways to quietly bleed risk out of a portfolio if you stop paying close attention.
Staying engaged, staying informed about the underlying health of your investments, even the ones paying you income, it remains absolutely paramount.
Absolutely. And this deep dive, remember, was tailored specifically for you based on the sources you provided. Hopefully this gives you a much clearer, more nuanced picture of the potential risks you need to navigate as you build out your dividend strategy.